webinar of EGROW Foundation, which is being done along with Task Force 5 under the G20. And this is the last in the series that we are doing along with G20. Otherwise, EGROW Foundation has done nearly 160 Friday webinars since we started about 3 years ago. Today's webinar is extremely important because if you look at the 2008 crisis, it was partly blamed on the shadow banks, the global financial crisis, partly blamed on the shadow banks, and it was said that in America, shadow banks accounted for nearly 50% of the financial system. That means they were as large, as significant, as important in terms of financial assets as proper commercial banks. However, in recent years, despite what happened in 2008, in the last 15 years, it has now been found that across the world, the share of shadow banks has increased from 40%, what it was earlier, to 50% now. And I thought that was rather very significant. The interaction between banking and non-banking systems has increased, has become intense, and therefore, if you look at the last Global Financial Stability Report in their chapter released in April, you find that now the IMF is talking whether the central bank should also get in and in the policy kit include what they should do for the NBFC sector or the shadow banks. So regulation is becoming necessary. It also emerges, initially it was not, but now it emerges that the transmission of the monetary policy significantly is carried through by the non-banking financial sector. And not only that, recent research by the Financial Stability Board now shows that the monetary policy transmission can become accentuated by the presence of NBFCs because they may start lending or stop lending faster than the proper banking system. So the issue with the non-banking finance companies, the shadow banks, has become extremely important. In recent years, for low interest rates, it's been found that shadow banks have been investing in riskier assets too. It is for that very reason that when we did under Task Force 5 and we looked at the international financial order, that's the main topic of the Task Force 5 under G20, we brought this in because we thought it is extremely important now. To discuss this very important issue, we have with us a very illustrious panel. Dr. Arvind Virmani is chairing the session. And then I'm going to just introduce the panelists and then introduce the chairman of the session before handing over the mic. Our first panelist for the day is Madam Shyamala Gopinath. She is the former governor of the Reserve Bank of India, where she has worked as the governor for 7 years. She is currently chairperson of the Standing External Advisory Committee for Grant of Bank Licenses, constituted by the RBI. She is also the chairperson of Board of Governors of IIM Raipur and a member of the Governing Council of RIS, a think tank of the Government of India in Delhi, and looking at the geopolitical situation. She was until recently non-executive chairperson of HDFC Bank, and she has also worked at the IMF in a small stint for 2 years. For all of us who have worked at the RBI, Madam Gopinath is an icon, known for her dedication and hard work in the institution. And now, as you can see, she continues to do that. As part of the Reserve Bank, she has been guiding and influencing national policies in diverse areas of central banking and regulation and supervision of financial institutions. If I recollect, she was also on the board of the State Bank of India, and I used to be in sitting some meetings where Madam used to come from the SBI side, and we were wondering as a deputy governor and then as in SBI, the depth of things that she holds. Our second speaker for the day is Madam Dakshita Das. Dakshita Das is a retired civil servant with over 15 years experience in the Ministry of Finance. The most important thing, and why we requested her to join us on the panel today, she was the MD and CEO of the National Housing Bank. People who know about the financial sector and the National Housing Bank would tell you that she was responsible for turning around the National Housing Bank. I had the privilege to be on the board when she was the MD, and I can vouch for it. The amount of hard work, dedication, and call for duty she brought to the office of the MD, because she came in at a very difficult time, is unimaginable. The risks that she took, but the way she brought about the changes in the National Housing Bank. As you know, National Housing Bank used to regulate and supervise, continues to supervise, but the regulation part has been taken by the RBI of the housing finance companies. Very important part of the NBFCs. She has considerable experience in the financial sector, as she was in the Ministry of Finance even after she gave up her job as the MD. She was looking at insurance, banking, and financial institutions. She is currently serving as independent director in few NBFCs while chairing a committee on gender budgeting for the Government of India. Our third and last panelist for the day is Mr. Sunil Agarwal. I have known Mr. Sunil Agarwal for nearly 5 years now. He is the MD of Paisalo Digital Limited, Paisalo Digital Limited, that is PDL. PDL is a non-banking finance company, is listed with BSE, NSE for its equity, and is mid-layer systemically important NBFC as per the RBI norms. Paisalo is currently co-lending partner with 5 banks and also national business correspondent of SBI. At present, PDL is doing its business from 937 locations in 11 states in India. And I think that's very, very fascinating statistics. Mr. Agarwal possesses a rich experience of 34 years in the finance business. His major roles include, but not limited to, brand building, fundraising, and strategically tie-ups for the PDL. He's also being invited regularly for deliberations. Given his profile and given the PDL's profile at various programs in the finance industry. To chair the session today, we have Dr. Arvind Virmani. Dr. Arvind Virmani is a member of the NITI Aayog. Until he took over that charge, he was also the chairman of EGROW Foundation. He has been a mentor to FICCI and member of RBI Technical Advisory Committee on Monetary Policy in recent years. Earlier, he was the executive director at the International Monetary Fund in Washington and chief economic advisor, Ministry of Finance, and principal advisor, Planning Commission. Before he joined the Planning Commission in 1986, he was with the World Bank. During his tenure in India, starting from the Planning Commission, he has advised, worked, and written on a host of economic policy reforms through hundreds of policy papers, notes, and committees. He has served as member Telecom Regulatory Authority of India and as Director and Chief Executive Officer of the Indian Council for Research on International Economic Relations. I would invite you to read some of his research, which will show you the depth which he carries, which are on the EGROW Foundation, and the one which is the most recent, written on Bharat model for economic growth, just about 3-4 days back. He has published extensively in journals. Some of them are refereed journals and book chapters. He has over 50 working papers in the areas of macroeconomics, growth and finance, tax reform, international trade and tariffs, international relations, and national security strategy. With this, I hand over the session to Dr. Virmani to conduct the proceedings further. Dr.
Thank you, Dr. Charan Singh, and thank you for the introduction to all of us. Let me just wade straight into it and ask Dr. Gopinath to start the discussion. Shyamala, please.
Okay, thanks. Yeah, first of all, let me thank my good friend Charan for inviting me for this seminar. And really happy to see Dr. Arvind Virmani and meet Dakshita Das and Sunil Agarwal here as my co-panelists. Well, in the context of shadow banking, I remember reading long ago one IMF piece which said that if it looks like a duck, acts like a duck, and acts like a duck, then it is a duck. So what about an institution that looks like a bank and acts like a bank and is not a bank? So that is the shadow bank. So shadow banks are financial intermediaries which resemble banks in their functioning as they carry out maturity and liquidity transformation and build up leverage. But because they're not subject to traditional bank regulation, they cannot, as banks can, borrow in an emergency from the central bank and do not have traditional depositors whose funds are covered by insurance. Basically, they're in the shadows. As you may all be aware, the term shadow bank was coined by economist Paul Macaulay in a 2007 speech. Actually, he talked about it even before the financial crisis at the annual financial symposium that is held at Wyoming. Timothy Geithner, like what Taran Singh said, he mentioned that he placed actually a significant blame during the GFC for the freezing of credit markets on a run on the entities in the shadow banking system by their counterparties. Both banks and non-banks use the shadow banking system to fund investment strategies outside of the regulatory controls governing commercial banking activity. As regulation on banks became tougher and core banking business became more competitive and less profitable, risks and assets were migrated to entities sponsored sometimes even by the banks themselves, the SIVs and the various the conduits. So even today, in fact, like you were mentioning, Taran, in the Global Financial Stability Report and others, I just read, some the Financial Times, something that former FDIC chief Sheila Blair mentioned in the context of this recent US banking issues. So she had said, the paper is quoted, that regulators have not really got to grips with private equity, hedge funds, and other similar shadow banks. So internationally, pension funds and endowments are investing large amounts into private funds and could be at risk of unexpected losses. So financial stability will get endangered if the turmoil spreads to public markets and banks. There is still lack of transparency around these entities. They may not use deposits, but they do resort to market-based funding, which is not stable, particularly during a crisis. So it is how banks actually interface with these non-transparent funds that can lead to systemic risk. So why were shadows bank, or why are even some shadow banks just even now kept out of the regulatory perimeter? The general opinion at that time was, while banks need to be subject to greater regulation due to deposit insurance, their role in the payment systems, and all of that, the entities, particularly those not accepting deposits, need not be subject to such regulation as it is expensive, inhibits the ability of markets to transfer risk, promotes financial deepening and innovation. It was argued that market discipline and self-regulation would result in better risk management by lightly regulated and unregulated institutions. We know now that really neither market discipline works nor self-regulation. It was believed that if banks are regulated, their own risk management outside the core would be consistent with systemic stability. There was complacency around that time that banks had strong capital and would implement strong risk management in their self-interest, and diversification of risk away from the banking system was welcomed. Even in India, there has been a move to say, banks have taken risk of infrastructure loans and there were a lot of NPAs. So there has been a move to say, why should banks do such lending? Long-term lending should be done through the bond markets. So it was considered, good for systemic risk if the banks, if the risk was taken away from the banking system for at least such forms of lending. Of course, now the extension of the regulatory perimeter to the so-called shadow banking entities has now become part of the conventional policy framework over the last 10 years. In fact, you're mentioning, Charan, that somebody asked you, why do you call shadow banks? There are no shadow banks. Of course, there are some shadow banks yet if they are unregulated and they still access market for funds and they can leverage some of the hedge funds and others. But the Financial Stability Board actually changed the terminology from shadow banks to non-bank financial intermediation to emphasize the forward-looking aspect and shed the negative connotation. However, the term shadow banks continues to be used. I think people understand quickly when you say shadow banks. Since the global definition of non-bank financial intermediation includes a large number of entities, the FSB itself has come up with a narrow measure where the focus is on assessing and mitigating financial stability risks based on economic functions. So for that, they had classified, even in this narrow measure, non-bank entities into 5 economic functions, each of which actually, all of these functions involves non-bank credit intermediation. That may pose shadow banking risk. Actually, we need not really regulate entities that don't pose any such intermediation risks. If they're using their own money for taking risk, it's a different issue. So the economic functions, they defined this narrow measure in terms of 5 economic functions. The first economic function one was our collective investment scheme, mutual funds, all of that. We know how mutual funds also got affected at the time of the crisis. Then the lending companies, the loan companies, the finance companies, housing finance companies, all of that falls in the second category. Then broker dealers, third category, insurance, credit insurance companies in the fourth category, and securitization. In India, if you ask me, it's really the finance companies, the leasing companies, and all that really are dominant in this narrow definition of non-bank financial intermediation. And even outside this definition, we don't have very large institutions. And in any event, there's no financial services activity that is unregulated. Just to understand the systemic risk, the 4 types of intermediation that cause this problem is really the maturity transformation, liquidity transformation, leverage, and credit risk transfer. So there are benefits of non-bank financial intermediation, and it should be recognized that this is essential to for a viable and well-functioning financial system to also have these kind of entities. It is modern, sophisticated, and a complementary way to share risks efficiently. It is necessary to provide for alternative funding channels which can support sustainable growth in the real economy. It supports financial inclusion since it provides credit access to firms and households that do not have access to bank finance. Not all such entities pose bank-like financial stability risks. The object of regulation is to transform shadow bank or non-bank financial intermediation to resilient market-based finance or intermediation. In India, the NBFC universe is vast, heterogeneous, and complex with different business models. The sector has evolved over the years considerably in terms of size, operations, technological sophistication, and entry into newer areas of financial services and products. There is an increasingly complex web of interlinkages of the sector with banks, capital market, and other financial sector entities on both sides of the balance sheet. The sector has also seen advent of many non-traditional players. Now we have Sunil Agarwal here, who will explain more to us, leveraging technology to adopt tech-based business models. While the development of a robust non-bank intermediation channel provides a good spare tire to the economy, unbridled growth fueled by lighter regulatory framework can also lead to potential system. So, in fact, the regulatory framework in India does enable NBFCs to have operational flexibility and develop sectoral and geographical expertise, resulting in a variety of financial services and ease of access. The general principles for regulatory measures related to shadow banking is that these should be carefully designed to target the externalities and risks that shadow banking system creates. It should be proportionate to the size of the sector and the risks posed to the financial system. I mean, I'm also just using shadow banks and NBFCs, but really speaking, there are no shadow banks in India. NBFCs are of many kinds. They're classified into 10 categories. I won't go into great detail, except to say that the investment and credit company category are quite dominant. And then we have infrastructure finance company, then we have the MFIs, we have the housing finance companies, we have the P2P lending companies, factoring, and all of that. So alternative models of lending and capital raising are coming up and have the potential to change the market dynamics of traditional lenders and the role of traditional intermediaries. In India, actually, NBFCs have been under regulation since the 60s. It started with actually protection of depositors. And then it was found that even on the asset side, many of these entities were making poor investment choices, leading to a lot of defaults to depositors. And therefore, they were also brought under a registration framework. Subsequently, the definition of deposit itself was enlarged to bring in all kinds of public funds. So whenever an entity goes to the market and raises money, whether it is through intermediaries like mutual funds or in the bond market, all of that was treated as equivalent to deposits and brought under the framework of regulation. In 2006, a calibrated regulatory framework was created to address the issue of systemic risk and prudential capital requirements, exposure norms, liquidity management. All of that was introduced mainly for the systemically important NBFCs, although at that time we did define systemically important NBFCs as above 100 crore. That was changed to above 500 crore. So above 500 crore are treated as systemically important financial NBFCs. And again, there was a change in regulations a little bit in 2014. And many of these regulations, it just doesn't deal with the systemic risk issue, but also of customer protection. We have the Fair Practice Code and all. Of course, post the ILFS and the DHFL crisis, a more rigorous regulatory framework has been in place, and even liquidity coverage ratios have been introduced for NBFCs above 5,000 crore. And the last change that has happened more recently, regulatory change, is the introduction of the scale-based regulation. And you did mention about the base layer, upper layer, middle layer, and upper layer. So again, it's 1,000 crore and below will be base layer, 5,000 crore and above is the middle layer, and the top layer really consists of the top 10 NBFCs and certain NBFCs in the top 50, which will be identified by RBI as contributing to systemic risk. And how do they assess that systemic risk? It's based on somewhat similar to how banks are defined in terms of the size, interconnectedness, complexity, supervisory inputs, and of course, weights are assigned to each criteria. So NBFCs have had to cope with several pressures over the last decade arising from the failure of ILFS, DFHL, the pandemic, and all of that. Over the years, they have shown a good degree of resilience, having built buffers, mainly in the form of higher capital, maintaining liquidity buffers and provisions to reinforce their balance sheets. And they should keep the momentum going. And in fact, in fiscal 2024, they are expected to grow 13 to 14%. And this growth is expected to be broad-based across all retail segments. That said, there are two key risks to watch out for. First, intensifying competition from banks, especially in traditional retail segments, such as home loans, new vehicle loans. Banks are also using technology and they are able to reach out, even further closer to the consumer. And second, the borrower. And second, the rising interest rate environment, which is translating into increasing the cost of borrowing for NBFCs, limiting their competitiveness in some asset classes. To conclude, NBFCs are integral for credit delivery. A robust regulatory framework is essential to support the growth of the sector in a sustainable manner, enabling them to diversify their funding sources and build partnerships that will help overall economic growth. In fact, even the lenders would very much like whoever it is that the sector is well regulated. And I think in this, in respect of these kind of NBFCs, I'm not talking about the broad non-bank financial intermediation. India's model of appropriate regulation, India's model of regulation could be a kind of an appropriate model and will assist growth with stability. So thank you very much.
Thank you. Our next speaker is Ms. Das. Over to you.
Thank you, sir. And thank you, EGROW Foundation, for having me here. Madam, to take off on what you quoted from the IMF paper, if it looks like a duck and speaks like a duck, is it a duck? Actually, the NBFC is more like a duckling compared to the banks. And we have not one or two of such ducklings. We have almost 10,000 of them in India.
Yeah, true.
So it's a huge ecosystem. And each sectoral NBFC is as a duckling, it's quacking or squawking in a different sector. Somebody is doing gold loans, somebody is doing education loans, somebody is in tier 2, 3 cities. More than anything else, we have to understand they are complementary partners to the traditional banking system. And that is something which somewhere in recent times, I think the message has, the message is getting lost in our over enthusiasm to prevent another crisis to happen. But let me start from the very beginning, as they say, and that's 2018. 2018 followed 2008, and 2018 is spoken very less in the economic history, Indian economic history, because for me, I think it was very well managed and the sector was very limited to the housing finance companies and a few others. And what happened then? And the biggest lesson which was learnt by those of us who were manning the posts where we had the uncomfortable task of holding the sinking ship and keeping it afloat, which also included worthy members on my board like Dr. Charan Singh. What was the problem? The problem was not that there was an absence of regulation. The problem was that there was an absence of niyat, as they say in Hindi. Now, you see, when you set up a company and you speak to most of these 10,000, none of them want their companies to go under. None of them want any ED or any investigative agencies entering their homes and their offices. And at the end of the day, most of them want a very robust bottom line. But with all of that, yes, I handled the crisis of my lifetime. And it was not one company, but it was 3 companies which were giving us trouble. We used to call them the bad boys. I mean, luckily you can take a gender tilt in such matters because they were bad boys. You see, we were regulating them. We were inspecting these companies annually. Each year, because of the size of these companies, our teams were going. And then I found the real catch. The real catch was the plethora of rules and regulations with which my teams would go to inspect these entities. So they would come back with a very tunneled type of a conclusion, saying tick, 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 this is done, this is done, this is done, this is done. So everything was hunky-dory on paper. But what we didn't know was that somewhere the promoters or the business interests were leading in different directions. Those directions linked, LLPs were being set up. LLPs were becoming a bit of very huge that time. And at that time in 2018, LLPs were regarded as a really bad word. But we all know that LLPs are a living reality in India. So everybody was falling over themselves trying to find out what was going wrong. And at the end of the day, I found that no matter how much of supervision you do, you can't supervise enough. So when I come back to my experience, I found that in the 100 odd page reports which were generated each year on these large companies, there was only 3 lines devoted to the LLPs where so-called fund diversion had happened, or wherever the problem was happening. Now, what did I do? Because NHB is a very small is a very, very small player. And we found that there were group companies, and we found that these companies had been so large that they had spread their tentacles into insurance, into affordable housing, into lending, because at that time, before RBI stopped them from having the power to take deposits, a lot of these were continuing historically with deposit taking powers. And that was scary because the depositor was a very small player. But what do you do? So we started, we looked at that little 3-line para in that 100 page report. And then we called the team which had gone on inspection. We said, what's this? He said, this is not in my rule book. So I never looked at it. But that was the crux. And it was a repetitive crux which was coming out in 3 years. So we created a spate of regulations, we tightened things, we stopped the deposit taking power, we did a lot of things. But as they say, the horse had already fled from the stable. So we come back to now, with my experience, what I came to the conclusion was that no matter what you do, no matter how many regulations you have, no matter whatever the rule books say, there are 3-4 things which are very critical in controlling this sector, which can be called shadow banking, stroke NBFC, stroke, I don't know what, ducklings. Now, what we come to the conclusion is, one, that inter-regulatory flow of information is extremely important. Inter-regulatory flow of information in terms of at least the systemically important companies, because that's where one regulator gets to know the risks the other regulator is seeing. We have IRDAI, we have PFRDA, we have SEBI, we have, of course, RBI. And RBI, pardon my saying so, it's got too many things on its plate. NBFC regulation can only be assisted by flow of information, which is where it's very critical that there should be an interregulatory forum to discuss such companies, and wherever any toxicity is noted by one over the other, or any quiet flow of information is required, then what happens is that everybody is holding up the other person. So that was the one thing which I felt a serious gap which existed, because when I would go to one regulator or the other, there was an absence of adequate information or recognition that there were red flags. So those red flags can only be picked up when regulators come, and we can say that we have a forum, but we don't have an active forum to take care of the companies' information. The next thing which I feel, and that is even more important given the fact that now we have a lot of operation happening in the over, apps and things like that, that your next crisis which is going to hit India or anywhere, it's going to be a war which will be fought over the net. It is going to be a war which will be fought through people entering, through hackers, through, through things like that. So I don't think there can be any regulation for that, because that's a crisis of sort. You can, again, there you can say, why did you not see this? But that's post facto. The real issue which is coming in is that all of us are interlinked in a very global village type of a scenario, where there are too many things happening and where there are too many players and there are so many equal number of people willing to enjoy the party and jump in by hacking, entering a system, making it making it void for businesses to run appropriately. And what does a regulator do then? A regulator is actually helpless in such a situation. A regulator can only tell the entity that, why did you not do this? So that's going to be one big crisis, and that's a crisis of existence for the company. It's also a crisis for the people to whom the company is catering to. So that's something which is going to come up. So one of the models which I had explored then, and which we had done a small pilot on, was an AI-based intervention to conduct supervision, where we had taken a time series data for the last 10 years. And the little entity whom we had picked up, it was a bunch of young kids who were just out from some technical college. So we just blindfolded them and said that if this problem arises, can you pick up the toxicity? And then we found to our delight that yes, AI is a powerful tool for picking up any red flags. And if those red flags are picked up, then one thing which happens is that there is no crisis. At least there is no crisis where the regulators have to run in and say there is an asset liability mismatch, which is so typical of NBFCs, because they are borrowing short for a long-term asset or a long-term loan. Housing is protected because it is asset backed. But what if it's an education loan? We've seen how education loans have become so toxic in certain parts of the country and how many banks are suffering because of that. And the other thing which is there is also that to protect NBFCs from having a problem, if we have a supervision which is based on red flags, at the first stage when a dialogue happens between the shadow banks or NBFCs with the regulator, the flag is raised and indicated to them. What we have is still a largely manual based approach where we rely on physical records, we rely on the auditors, we rely on the credit rating agencies, we rely on so many things, and actually we wait for a crisis to hit us. What we need to do is to step back and have a model which predicts the crisis. I also, in that context, I'm quite delighted to read on the net one of RBI's, I don't know whether it was RBI, but I read it on the Hindu Business Line, where they admitted that to regulate these 10,000 odd babies stuff, so they're going to outsource the audit to other parties. Now, outsourcing of audit, whether it will yield the desired results, I can't say, unless tech and data convergence through the interregulatory work is taken on board. My take to conclude is very limited. We need interregulator coordination at a very serious level, at a very high level where regulators should meet. Maybe you don't need to meet at the top level, but you need to meet at a level which is able to figure out these problems. The other is that we have to have more assisted supervisory practices. In fact, what India needs is an overall supervisory centralized entity so that there are across various companies and entities, there is a pan supervisory uniformity and people are trained to pick up what the problems are. We also need to have regulations which are linking the entire space to the future wars which are going to be fought on the net. My sympathies are totally with the NBFCs. I think most of them do want to survive. Maybe one or two rogues bring a bad name. Also, if you go to smaller towns, I had the good fortune of visiting a one-horse town in Uttarakhand recently, where all across there was somebody called Ram Singh Bisht, who had everybody needed to approach if they wanted an education loan or if they wanted a housing loan. I was quite intrigued. I said, which entity does he belong to? So they mentioned the entity's name. It was a small entity. Why don't you have a bank? Why don't you go to the bank? There is no branch there. Banks are limited. Banks can't expand to that scale. So what we need also is a hand-holding between the NBFCs and the banks. So the big duck, the big bank and the small duck come together. Thank you. Those are my.
Thank you. Yeah, actually, I was wondering about the lessons of 2018 crisis. So that's good. You've given some interesting lessons from that, the inter-regulatory coordination and the cyber risks and the use of AI. I think those are quite useful suggestions. With that, let me turn to Mr. Agarwal.
Thank you, sir. Thank you, Professor Charan Singh ji, to have me on in this elite panel. So I am probably the youngest, that's for sure. And I run a, just to tell the elite panelists, I run a small finance company. We started in 1992, so it's been quite long. Starting from a market cap of about 3 crores in 1996, we are today about a 3,000 crore market cap company. So our shareholders have been well rewarded. So speaking about the shadow banks, the future of shadow banks is literally to work as a shadow of the bank in low ticket size loans, managing and sourcing as well acquiring and testing new tech before the banking system adopts. This is what my feeling is, and RBI has perfectly come out with the co-lending regulations in this regard. These co-lending regulations are not only enabling a very interesting tie-up, transparent tie-up, I would say, between the banks and the shadow banks, because we're today using the shadow banks word. So I'm used to using non-banks, but I'll try and use the shadow banks. So this has advantages because the low cost of operations of the shadow banks, along with the low cost of funds of the bank, is actually enabling the country's cheapest finances available to the bottom of pyramid customers. We cannot forget that this country has a population of 140 crore people, out of which only 6.5 crores are filing income tax. The entire finance sector, be it banks, be it shadow banks, they are first thing they ask is, what is your income tax return? They are calculating the loan availability based on that return. Very right to do so. I don't want to challenge that process. But what happens to the rest of the people? Even if you look at the credit bureau data, all the 4 credit bureaus today taken together, it is assumed that they have a data of about 15-16 crore people. So if you try to unique that, I'm sure it would drop down to 5 crore people. So this means that only 10 to 12 crore people in our country have been able to borrow money from regulated entities. That makes it just 10% in spite of the huge and humongous task which Mr. Modi took by opening the Jandan accounts and trying to build the digital lending system, all these new age fintechs and what all not. I would also like to take this opportunity to congratulate RBI in bringing this co-lending regulations. RBI, whether it was 2008 or whether it was 2018, the way RBI has handled the crises, which we are seeing that currently large developed banks and large developed nations are finding it difficult to handle. Here, nobody lost money, even in case of the PMC bank or any other bank. It's a commendable and a thing which cannot be achieved in a democratic nation of our size with length and breadth and language changing every 50 kilometers. It's no mean task. We must actually applaud every one and all in the RBI for achieving this great success. We have today 2 prominent people from RBI sitting on this speaker panel. I would also like to tell that RBI cannot keep on under-regulating the new startups. You see, the problem of RBI is that you are expecting them to regulate the banks. We cannot forget that number of banks in the country, if you add the entire cooperative bank sector, suddenly becomes so big. And then if you add another shadow banks, what we are talking is not 10,000, what ma'am was mentioning. It is actually said to be 40,000. They are core investment companies. There are other things. So probably somewhere now with the growth of the GDP now touching almost $4 trillion, and it is expected by the 100 years of our independence in 2047, we will be a $40 trillion economy. So things which are right today cannot be right tomorrow. We probably are not looking at a 5-year plan. We need something which is called 25-year plan. So we should now try and prepare a 25-year plan. So 25-year plan, I believe, cannot be by over regulating. It has to design, we need to probably design a space of work, and we need a specialization. I really don't understand why should a bank be also an insurance company. The moment I borrow money from a bank, suddenly the next day the branch manager comes and says, Sunil, please take an insurance policy. That's our bank policy. That it is not cross selling, sir. It is actually force selling. Our lot. So I don't understand why it should be there. Everything is becoming very specialized a job. We don't go to a eye doctor to get our flu treatment done. We actually go to a specialist doctor to get it done. So that's how we probably need to stop banks entering into NBFC space and trying to open an NBFC. You would notice that a lot of banks have now acquiring NBFCs, stakes in NBFCs. So they want to have their legs in both the sides. That's not done. They have a broader license to operate as a bank. They have an ability to raise cheaper deposit. Their mandate is totally different. RBI gave them banking license not to open a non-banking finance company, but to run a bank. Non-banking finance companies to run like a non-banking finance company. Second thing is these new age startups, which so-called fintechs, which we use, most of them are calling themselves fintech, but they are actually now suddenly realizing that the only business is and the only way they can make money is to lend money. So they are trying to enter into that space. A lot of them are still found to be unregulated. We have seen the Chinese app market where they were doing business without thing. So they are also misusing the data. That's the biggest crux. I would I would just like to recall what Madam Das just mentioned. She said about the hackers, she said about the world war being fought not on the ground with the weapons, but probably on the computers across in the country to create a havoc. So data is going to be the new problematic thing. So we need to probably design a system what data access is permissible, what data access is not permissible, number of data points which are being increased. We do the same data on PAN card, we do the same data on election card, we do the same data on Aadhaar card. We need to probably, now we are talking about the national population register also. So all those things getting mixed up. I'm seeing a multiplication of data management and complexities involved in that. Another thing which I will like to touch base, Madam Gopinath was very kind enough to remind us about the wonderful prudential norms, which have actually helped the entire sector to grow right from 2005 to today, what we are after 15, 18 years. Ma'am, we were introduced and the sector, the entire country was introduced to ratings in that thing. That was the first time bank borrowings were bought under the external rating framework. So to the best of my knowledge, whatever little I've been able to find out, we are the only country in the world which is making external rating compulsory for the bank borrowings. See, the purpose of the rating was to advise an unaware customer what is the strength. If a person is subscribing to a debenture, if a small person is putting 10, 15,000, so he understands AAA, AA kind of a thing. That's why the nomenclature of the rating symbols were kept simple, A, B, C kind of a thing. Now an aware investor like a bank doing a loan transaction which has access to the entire data of any company in this country or any borrower in this country is unfair to that extent. Banks have suddenly and the people have suddenly, we as Indians have an habit of piggy riding anybody else's back. So bankers think, oh, it's very fine, this company is AA, this company is A, so let's just say, oh, no, we did this lending because it was a AAA company. And we have just seen, Ma'am Das has faced that music in 2018, all the companies which went the haywire because of the diversion of funds were AAA rated. So in fact, the need of the hours is that now the banks have the entire data, because starting 2004-5, the banks have been collecting data. Banks have now been able to design and create a internal rating process. I can vouch, I deal with 15, 16 banks. Almost every bank has a better rating mechanism what the external rating companies have. We need to review the external bank rating requirement for bank borrowings. That's probably the need of the hour. 18 years is a long time for any bank to develop a system, and that system is technically in place. Also, probably now, since the RBI is at a very crossroad because it is being expected to control the cooperative banks, and a lot of these cooperative banks are actually very small bank, and they have their own importance in the region, in the locality, in the community. Most of them are community based or a trader based or a market based kind of a thing. So probably the RBI will have to look at a way, if the merger between these cooperative banks is allowed or merger within the small finance banks is allowed, it is going to be very Herculean task for RBI to control 10,000 cooperative banks, 100 banks, and another 50, 60,000 NBFCs for that reason. And NBFCs are bound to grow. Our economy is growing from 4 trillion to 40 trillion. So another 25 years, we won't be surprised if we have another 3-4 lakh entities joining as non-banks companies. So probably a lot of things will have to be reconsidered, reviewed, and probably EGROW Foundation can take up a study. I'll be ready to support Dr. Singh, Professor Saab, in any manner I can, my company can, any manner I can, to just design how we can plan a 25-year roadmap to regulate the sector. Unless the regulations are there, it won't be there. But regulation means that we design a system, this is the framework. This is to be done. Thank you. You are not allowed to construct. The problem starts the moment we say, okay, this is a building to be built. You are allowed one FAR, but you can do 1.5 by paying another 5, adding 5, and by paying some penalty. No, thank you very much. We don't want that. It is one means one. We need to probably design now new regulations which do not allow any space to violate them. That's what Prime Minister Modi wants. That's what Prime Minister Modi has been doing for last 9 years. The last 9 years, what changes we have seen. are not seen by countries in last 100 years. We all will probably agree. Whatever I'm 52. I've worked in finance for almost 33. I started at 18 years of age, and you all have seen entire life happening. But last 9 years, the changes in finance and the excitement in finance, the control mechanism, the way it has turned out for the country, and the way we are seeing the GST growth, the GDP growth, and other all numbers. Even agriculture sector is continuously growing by 4%. The farmer income is increasing. Prime Minister has been able to execute and implement growth in incomes for one and all. So with this words, I would actually like to express my thanks once again to the elite panelists, and would like to say thank you all for this thing.
Thank you, sir.
Thank you. Thank you. That was very short and to the point. Dr. Charan Singh, yeah, please go ahead.
Sir, as you know, it has been an excellent panel and excellent contributions, but I had some very quick observations which I thought I'll share. And then as chairman, I leave it to you how you would like to. Most of the times I've seen, and Madam Gopinath would agree with me, that in the Reserve Bank, we used to believe in the system of self-regulation. Madam, if you recollect, we started the primary dealers and we had a self-regulatory body of the primary dealers. So was the story for the foreign exchange. I'm noticing one thing, even in the latest global financial stability report, while they talk of the toolkits with the bank, with the central bank, self-regulatory body of NBFCs is probably not being discussed. And one of the reasons I thought they were not being discussed is what Madam Dakshita Das brought in, the heterogeneity in this sector and then the size of this sector. While Madam Dakshita Das spoke about the ducklings, if we recollect 20 years back, we had even the dinosaurs. And they were all part of the non-bank finance companies in terms of IDBI and those entities which were there to start the industrial development in the country. They were on one extreme, and then the ducklings were on the other extreme. Now, how do you bring them together? And one of the thoughts that was that in case we go sectoral, insurance ducklings, then housing ducklings, maybe that would help in regulation as well as help in data collection and identify the data gaps. But that would also help if we could have, like the primary dealer self-regulatory body, a self-regulation. The second point I wanted to make is, Madam, you've been at the IMF, I worked there. Chairman, sir, you have worked at the IMF. I'm surprised. Housing sector is a very important sector in any country and very, very important for recovery. But I fail to see that on housing finance at the IMF, who would be really looking at it? And should they have a sector defined department or how? But I generally get a feeling housing sector has not been that well taken care, despite the fact that the mortgage-backed securities and the asset-backed securities, but mostly the mortgage-backed securities emerged from the housing sector. So I was wondering if IMF should do another conference and look at this, because that is where the problem started. And then, of course, it percolated. I also feel the last point, sir, I want to make is, and then have the reaction, is the risk in the NBFC sector has really increased, and actually it starts accentuating the cycle. Now, with the interest rate cycle moving so rapidly from aggressively rising to anticipated aggressively falling, and which followed a low interest rate regime, which was also aggressively very low. What is the resilience that these NBFCs have, and would they cause immense harm to the banking sector as they're getting integrated? Thank you very much.
Thank you. Yeah, I think that's a useful reminder about self-regulatory organizations. Yeah, how do they fit in the structure? So maybe you can take up Mr. Agarwal's offer and launch a study of the regulatory system. Maybe they need a relook, and also within that you could also address like the issues you said, that is there more work needs to be done in this context on housing and real estate sector as a whole and lending the nature of the markets, how they are evolving, etc., and the connection with the World Bank, for example. Okay, so I think the good thing today is we have time for questions. So I'll, given that this is the last in your series, let's open it up for questions. Can you, I guess people can put it in the chat box or raise their hand. There's a mechanism for raising the hand, which I can see. I don't know if I can see all the people. Charan, you have somebody who's looking at the chat box. Here we have. We have one hand here, Mr. Prabhakaran.
Yes, sir.
Go ahead.
Then Matthew Curran also. Then we also have Mr. Matthew and I think Professor Ashima Goyal.
Okay, sorry. Yeah, just wait. I see Dr. Goyal here. Would you like to come in and make some comment or question? Dr.
Sir,
Goyal?
I just wanted to say, since this is the last of the series, I wanted to thank you. Can't hear? Since this
No,
is
sir.
the last of the series for TF5, I wanted to thank EGROW. It's been a very
Your
useful.
voice is very dim. Charan, can you hear her? Yeah.
Yes,
Okay.
yes, she's saying as it is last in the series, she is thanking EGROW for hosting this.
Okay, yeah.
Yeah. I also had a question. Very nice to hear about the Indian policy scene and all that was done in terms of regulation. But I just wanted to take forward the contrast with what is happening abroad, because I recently did a policy brief.
I'm sorry, I can't hear. Charan, you'll have to interpret.
So I
or
think
make your point. I can't hear it.
Professor Goyal is referring to the international experience
Yeah.
and talking about, I think, the policy limitations. That's what I understood from her feeble voice. Is that right, Professor?
Charan, I think I'll just try to join on my computer. Just give me some time. Yeah.
Sure.
Maybe you can bring the.
To take some
Okay,
other questions.
Sure. Sure. Sir, can we go to Mr. Matthew Kurian?
I don't see him, but I'll
Hello?
come back to him. I'd ask Prabhakaran be a quick comment or question, Mr. Prabhakaran.
Yes, sir. Yes, sir. Sir, in RBI, sir, is one of the part is centralized bank, sir. So, what are the benefits from another bank, sir, in private sector and sir?
Okay, perhaps later Mr. Agarwal will take that up, but right now, Dr. Kurian.
Yes. Can you hear me?
Yes.
Okay. I have a global question. After the Washington Consensus, the world has shifted to globalization. And now we are in a new stage of globalization, which we call financialization. To me, this shadow bank or that banking system is an outgrowth of this financialization. And we all know that the essence of financialization is not proper banking, it is, or it is a speculation. And so the world economy is undergoing a process of speculation, and we are, India, also part of globalization, financialization. So my query is, when we refer to this sort of regulation, how can we ignore this sort of a global financialization? Thank you very much.
Thank you. I'll just take one more question and then get a reaction from the participant. Amit Kumar, you can also ask your question. Amit?
Good evening, sir. Am I
Yeah.
audible?
Yes.
Sir, as per RBI, we don't have a very good data of NBFCs, and you know that NBFCs have taken loan from the many commercial banks, national banks. So, what is the implication when we say NPA of a banking sector when we do not have a NBFC data?
Thank you. Anybody, any of our participants want to take this up? Dr. Gopinath?
To reply to Mr. Amit's address, sir.
Yeah, no, RBI does have data on lending by banks to the NBFC sector, and in a aggregated manner, it is, you do get that data. Like RBI definitely looks at bank lending to NBFC sector. So it's not that the data is not there.
I want the
Individual bank
quality
lending naturally,
data, depth
no,
and
quality
quality of
means if
data.
you want to know which NBFC has borrowed how much from one bank,
Yes.
that of course cannot be disclosed because it's commercial information and they
Yeah,
can't be disclosed.
having available versus disclosure are two different things. Yeah.
Yes, yes.
Ms. Das, you want to say
So, all
something? And
banks-
then Mr. Agarwal?
Totally. My point is that just in this question lies the paradox of the situation. Because when I quoted that there are 10,000 NBFCs in India, where I was quoting from one of the newspaper reports which quoted RBI, Mr. Agarwal said there are 40 to 50,000. So the sheer paradox it emerges. Actually, the thing is this, that the central bank priority, should it move towards NBFC because that will make it a huge monstrous situation, or does it have a separate regulatory and oversight mechanism for NBFCs, which by the way India has had. India had a very good tradition of having sectoral monitoring, housing finance being one case of point, for instance, infra finance through IIFCL. But somewhere down the line, it was felt that there was a lot of problems in their internal thing. So what we need perhaps is an entity within under RBI to have this database so that we reconcile 10,000 or 40,000 and we also have a commonality of approach.
But I think how the Reserve Bank has handled, and even in the recent scale-based regulation, is really, first is the NBFCs that are deposit-taking entities and NBFCs that are not deposit-taking entities. Of course, now we don't allow deposits to be taken. So those who are taking deposits, the NBFCs, not the housing finance, they have been grandfathered. And for the NBFCs, there's the smaller NBFCs that don't cause any, huge risk. The regulations are, there are no regulations. There is a registration requirement, and then they don't have capital adequacy and all, but definitely the leverage is limited so that the extent of oversight, RBI can't inspect 10,000, and then they don't have, of course, the NPA norms are there, and they have to do KYC, and they have to follow the fair practice code. But for above 500 crore, there is again depends on below 1,000, above 1,000, and then the above 5,000, and then the upper layer of the top 50 NBFCs. So a very calibrated approach is being followed by RBI for regulating the NBFCs and the bank. In fact, now the way RBI itself is structured is to have all regulation. It is entity agnostic. It's not bank separate, NBFC separate. So they have one department of regulation regulating all the entities. Similarly, the supervision. Then even for those banks that have NBFCs and housing finance companies and all of that, we invite NHB also for those supervisory meetings. Supposing, like for instance, HDFC, of course, one of the largest NBFC housing finance, even NBFC as well as a housing finance company is the HDFC, and we would, of course, they would be there. Similarly, ICICI Home Finance, NHB. So it's been there, the interregulatory coordination, and so that it has to be that way, that you have a differential regulatory framework to deal with what risk that particular entity poses, and then to limit that risk, you limit leverage. That's how one goes about, because leverage is the issue, borrowings. So that is how it has to be done.
May I just come in over here, sir?
Yeah.
Point is that it's a commendable job RBI has done in coming out with the regulations. The whole thing is that it is supervision which is the root cause of the problem. The issue is of supervision. That's where you come to nuts and bolts. It's a difference between theory and practice, because that supervision picks up the red flags. And that's where the convergence of information and that's where the convergence of practices is important. And that is why there is a need that this should be seen as a uniform entity which should be operating under a single umbrella. Mr. Agarwal has raised a very valid point that when I go to the bank, why am I being asked to buy an insurance cover? And mind you, who's regulating that? That's being regulated by, insurance is regulated by another entity. So we need a monolithic entity to look at the implementation of the regulations. That's the short point.
Actually, the international practice, I mean,
Yeah.
the international experience with this kind of a super regulator or one entity regulating or supervising, happened, and and the global financial crisis still happened in those countries, and then these countries had a relook, and then they again started having what is called the twin peak regulation, market conduct separate, the regulatory and supervisory, and then you have the central bank as a monetary policy.
Yeah, thank you for reminding us. Yes, I remember that. Yeah, earlier there was a huge consensus emerging.
That there
on
should
a
be one
single
regulator. Yeah.
Then it went the completely other way. So it's constant churn. Yeah, thanks for
So
reminding
it's not.
us.
It's not it's not just having different structures. I mean, no point in just changing. But I agree with Dakshita Das that actually more intense supervision and more sharing of information that really helps. And that is what I think now the entire supervision also is in one department, like all the NBFCs would be one. If they are related entities, they will be supervised together.
Thank
So
you.
all of
Thank
that
you.
is done.
Mr. Agarwal, would you like to add anything, or should we move on? Can't hear you. Mute.
Sorry, sir. The number of entities which are having NBFCs, which are having above 500 crore assets, are in still very lesser number. They won't cross 300 to 350 across the country, although we have 45,000 entities. And RBI has a very strict mechanism of controlling them. That is how we have seen no crisis happening in particularly NBFC sector forever, even for last 15-20 years. And God willing, it would continue to be like that for all time to come. Also commenting on the SRO side, sir, Madam will recall, a Finance Industry Development Council was incorporated, and we have been struggling. I was one of the, I've been member since day one. So maybe God willing, one day it would actually see light of the day.
So what is the problem with setting up self-regulatory organization?
Sir, the regulations will have to be done for the smaller NBFCs. The problem is that we suddenly start trying. See, our country is a very large country. We cannot have one solution for all. There are so many issues. So probably large entities should be going to the RBI regulation, and entities say up to 25 crores, and another up to 50 crores, up to 100 crores should have been a self-regulatory kind of a thing.
But they are spread so much, all over the country.
I know,
they've had such problems with the smaller NBFCs.
Yeah.
Borrowing money, not repaying. Oh God, I don't know how the SRO will even can manage unless you set up some
digitalization will be a solution.
SROs or
Digitalization will be a solution, ma'am. Probably a single
software. Digitalization, submitting reports, audited reports.
No, ma'am. Probably the GST kind of a portal that everything is happening on a single portal by all these smaller NBFCs. The full stop. No malpractice can take place.
But somebody has to look at the data, that information that's on the
You will have to, because the self check will automatically build in the in that software, no? So the things will be controlled.
That's
okay. Yeah. So that's a good suggestion, Mr. Agarwal. I think worth noting. I hope Dr. Charan Singh is noting these. I think he should do a study. Anyway. Hello. Let's take some more questions.
Sir, I wanted to make a quick observation, and that was, Madam Gopinath would agree that India took a lead in two things. Firstly, we never called them shadow banks. We always called them non-banking finance companies right from beginning. And second thing is that we also took a lead in regulating them. Madam, correct me if I'm wrong, but I thought under Dr. Reddy's regime, when we saw what was happening in the Asian crisis, we started thinking that which are the vulnerable points, and we brought in the cooperative banks and the non-banking finance companies very quickly under our radar and lens, and we started saying what is systemically important. And this division that we did, deposit taking and non-deposit taking, emerged in a way. It was an evolutionary thing where we said, okay, we need to regulate them, then these are the ones which become systemically important, and these are the ones which we can ignore. And I think the ones which we really talk in the report on trend and progress of banking in India, a statutory report which for 2 years I also wrote. We do take those entities into account which we are able to capture. And therefore, the 10,000 odd is something which we know. Certainly, we agree that there are many of them which are very small, which are out of the radar. We didn't keep them under radar, but they're too small and therefore out there in the system. Would that be correct observation, madam?
Yes, certainly, because I think even as I mentioned that in 2006 itself, we started, categorizing some NBFCs as systemically important NBFCs, which was unheard of in globally, much before the financial crisis. And so then we started doing this differential regulation. We tightened regulations for large entities. We dealt with this. I'm sure all of you all have heard of Sahara, the residual non-banking finance sector, where we had two big companies there, and we had to kind of ensure that they gradually, wind down and get into other areas. So I think India has, yes, you're right, under Dr. Reddy, we took a lot of measures and preemptive steps, and which the world had not even thought about. The word systemically important at that time for the NBFC sector, definitely not, probably not even for the bank.
So there is a question in the chat box and there's a hand by SK Prakash. What would you prefer? You want
I'll come to that. I can see I've seen one question also, but Dr. Goyal, are you ready to, let's try that. If your voice is, I still can't hear. Are you mute? I'm afraid I can't hear. I don't know what's happening.
I'm Prakash.
Yeah, okay. So I'll take Mr. Prakash. Sorry, Dr. Prakash. I can't hear you. Sorry, Dr.
I have
Prakash.
Yes, can you hear me? I have a small suggestion.
Just bring the thing near you. Your voice is also very poor.
I have a small suggestion. RBI can now diversify and go for a customized regulatory framework because of the financial world is becoming so they can go for a diversified, customized regulatory framework. And they can take the assistance of AI or the latest technology, and they can diversify, and they can go for customized regulatory framework.
Okay, good. I'm sure somebody's noted. So, Dr. Shyamala, there's a student, I think he wants to know why does shadow banking need to be regulated? If you can just simply explain.
No, yes. Actually, the reason why shadow banks need to be regulated, I mean, we don't need to regulate all that are in do some form of financing business. For instance, if you use your own money for lending, then nobody need to regulate that. So only those entities that actually borrow, like I mentioned, the intermediation function they do, you borrow short term, lend long term, or you borrow funds to invest in long term assets, or you take cash like liabilities. That is, you take liabilities committing to allow withdrawal anytime, but on the other hand, on the asset side, you have maybe illiquid assets or partially liquid assets, like the mutual fund issues happen, the liquidity problems that happen. If you take liabilities, you can sell your units anytime and get your money, whereas on the asset side you may not be able to liquidate all the assets, or you may be able to liquidate only at a loss and all of that. So only entities that you transfer credit risk. The loan is given and then you transfer credit risk to the other party. So this is where only entities that really are leveraged, that borrow, or even if they borrow short term and lend long term, or borrow funds to invest in assets which are illiquid, or borrow cash like liabilities and then invest in partially liquid or illiquid. Only these NBFCs are to be regulated, and that is why I mentioned that even the Financial Services Stability Board has come up with a list of economic functions which require to be looked at, because these are the entities that actually do such intermediation. I don't know. I hope I've answered you.
Okay. Yeah. Thank you. Any other questions you see, Dr. Charan Singh?
Yeah, there is a question here, sir. What about continuously losses the bank's intensity towards the loans and public deposits? Is it indication of shadow bank crisis in India?
No, I don't know. I think of course, we had this asset quality review. There were all types of assets, infrastructure lending for various reasons. So it's not that in India, at least, the global financial crisis happened because both banks and non-banks went to use the shadow banking to do certain trades, and particularly what Dr. Kurian was mentioning about huge financialization happening, and there is use of credit derivatives, use of very complex derivatives, and that is what happened. But in India, we've not had any such, the bank NBFC linkage is there because they do borrow, and they have, also the NBFCs borrow in the capital markets, to access the bond markets. So there is a linkage, but there are regulations. We cannot say that there'll be no failure at all, but it's the losses of the banks so far, at least even during the worst times, whether it was 2008 crisis when there was a problem, whether it was the 2018 ILFS. Of course, RBI came up with some measures. The government also helped a lot at that time to create, giving some kind of a backstop. So have been managed well. And I must say that particularly after the 2018, the NBFCs are really conscious of the risks in their balance sheet arising from either liquidity risk or from the ALM risk or even asset quality risk. Therefore, I think as of now, the situation seems to be there will be some cases where there could be some losses, like of course DHFL and all, or ILF has happened, but we've not seen any bank losing big sums. Some MFI problems were there. So there were some MFI issues here, but not affected the financial stability of the banks.
What I would like to, sir, if you permit me, sir, I would like to supplement what Madam was saying. Madam, my own thoughts on both the questions, to me, they're partly related. The reason that we in India came down to really regulate and look into the larger NBFCs were because we found while we were regulating the banking system so carefully, and we were getting very good results out of it, there seemed to be some leakages that would happen. And I thought that leakage was either their relationship with the cooperative banks or with the large NBFCs. Now, these large NBFCs did impact the commercial banks, as you mentioned, one of them, Sahara. But then, as you know, in 2018, Madam Dakshita Das was facing some of the HFCs, big names, who were operating and hurting the banks because they were related to them. And there were another set of NBFCs which were diversifying the funds, and the banks are still reeling from writing off their loans because they had extended support to them. So my feeling is that firstly, the vision of people like Dr. Y.V. Reddy, that while we regulate these entities, there could be leakages from somewhere. They need to be regulated too. Secondly, these entities themselves were becoming large and causing damage because of the financial integration that was happening. I thought I'll just supplement to what all you mentioned.
Just, I would like to add just one thing, not take too much of your time. One of the reasons, where we had these NBFCs growing very, very quickly and rapidly was also the issue of regulatory arbitrage. And that is why now the RBI has kind of having some kind of common uniform regulation of very, very large NBFCs that almost are like banks. So that's how, the regulatory arbitrage will be there, but for the larger entities, the RBI has made it more stringent.
So
there are a couple of questions. Should I read it, sir?
Okay.
This is Madam Ashima Goel's question is, Indian regulation is much more broad-based. In the US, it is narrowly bank-focused. I don't know if Madam Gopinath would like to make an observation on that.
Before she comes in, I did want to, that's exactly what I was going to talk about. Basically, for your general listeners, the legal system everywhere in the world is a 0-1 thing, so you can only say whether you're guilty or not guilty, or whether you've done something wrong or not. The whole point of a regulatory system is that in certain areas, because of information, because of asymmetries, like the financial system, there is a whole gray area, and you cannot have a simple legalistic interpretation. So you have a regulations and you have a regulatory system which makes judgments about it. Now, and the third aspect, which is kind of different for India, one is that our legal system has over the last many decades has been weak. The second part is the pressure, the democratic pressure from small savers. We have, the Indian savings rate is among the top in the world, the household saving rate. So there's a lot of democratic pressure from people's savings. So these two things taken together make our system much more regulatory. I mean, if you look at it in an international context, you would say it's over-regulated. But I think in the Indian context, these two things kind of justify it, because there is so much pressure whenever things go wrong. So it's better to have a little stronger regulation than would be, let's say, in America or perhaps even in Europe on average, because of these two types of pressures. So what the history is that we've evolved a regulatory system as we've had these cases. Madam Das talked about the 2018 lessons. We've taken lessons all the time from 1950, 60 onwards. We take every lesson and we try to adapt our regulation. So on that front, we've done pretty well. Now, I think Mr. Agarwal has raised a very important question, Charan, which fits with your G20 and other things. There's, of course, our regulatory history and the reason which I'm saying, which could propagate. And somebody like Shyamala can give us a more precise version of this history. I'm just giving an overview, and that would be actually useful. If you want to use it in the G20 context, maybe she can make a listing of the various type of major reform events. I don't remember them that well now, but there have been many. So that is one part, but the second part is exactly what Mr. Agarwal is saying, is that to look forward now. There are a lot of more new developments. The world is changing. I think that's a very interesting suggestion of his, and of course, taking account of things which Ms. Das said about the AI and the new things happening. That's just one part of it, but the other part is just looking forward, looking at the changing environment, in a way generalizing what you're saying. You made some useful points. So that is the overall context where I think you need to put a little more structure on it, and it could be an important, kind of recommendation to the government. With that, we could take a few questions. You said there's some good question.
Yeah, Sir Mahesh Thakur, who's whom Mr. Sunil Agarwal was referring about the self-regulatory body amongst the NBFCs. He is here, and I think he would like to make an observation or two, sir, if you permit.
Yeah, please. I don't see him, but yes, please come.
Good evening, friends. Thank you, Charan Singh. Thank you, Arvind. Yes, we are, voluntary self-regulatory organization only because the NBFC is an heterogeneous group and we're not able to compile and collect the data as required. But then barring that, all other, code of conduct and all other services which are prescribed by the RBI guideline, our members are following. And as you know, we are doing very good performance since last 6 months because of the governance, compliance, regulation standards which have been met. And Shyamala, Gopinath will agree that all NBFCs, all top 100 NBFCs are doing well. And if there were companies which failed, there were aberrations either into housing finance or infrastructure finance, not the asset financing model which we are prescribing.
Yes.
So we need to be careful about now the fintech companies also or P2P companies, but the real asset finance and loan financing companies are all doing very well. And they have grown in size and stature because of the regulation and everybody following that regulation prescribed by the FIDC regulators and the Ministry of Finance. So we will, follow all the principles. And I was talking to Charan Singh, I would have loved to change the title from shadow banks to NBFCs but for the reason known to him of course G20. But if it is yoga, it is always to be called yoga. You can't call it yoga because if it's a foreigner. Okay. So any questions from anybody, I'll most welcome. And in between, I was missing out because I was in the seminar. Thanks, Charan Singh ji.
Yeah, thank you. So I think the important point you made, that is quite right. The infrastructure, I think a lot of that problem was infrastructure. There was a lot of pressure. I still remember, in fact, this is the one thing where I went public. I've never gone public when, my advice to the higher ups was ignored. But the one time I went public, I wrote an article, was when they were trying to force the use, Dr. Shyamala may remember, when they were trying to pressure RBI to use the reserve for lending for infrastructure. And I strongly opposed that, and I went public on that issue and wrote an article, I forget in which EPW or somewhere, against that idea. So yes, infrastructure caused a lot of problems, and one should not exaggerate the lessons and focus on infrastructure. But I still agree with the two suggestions Mr. Das made. So the second point I think we have to keep in mind is that it doesn't have to be the extreme of strong regulation and self-regulation. I think you could have a structure, Dr. Charan Singh, where in some sense the self-regulatory organizations are regulated by the regulator, but the actual thing is decentralized. So you can still audit the regulatory organization to make sure that whatever the things which are agreed and which have been accepted by everybody are being implemented, and back them up when somebody violates it. So that kind of structure I don't think has been tried. Maybe Mr. Thakkar can tell us, but you could think of new things. That's the point I'm making and urging you. And I like Mr. Agarwal's proposal that we have to think in certain new ways. And the very important point, the size. I keep pointing out in many different contexts that like education, health, the population of the USA and Europe combined is half of that of India. So the scaling up that we need to do is just tremendous, and we have to think of these new ways. And certainly, the internet-based. Whose suggestion was that? I think your suggestion. I think Mr. Agarwal's suggestion of having a portal. We know that portals like Gati Shakti are working very well. So I think that's a very good idea. We should consider that maybe some kind of a portal for these numerous organizations. At least it'll give some organization and thinking, because if they have to fill in the same thing, they'll have to think a little more systematically. If you prescribe that you need these 10 things or 15 things or whatever, they would have to think along those lines and think about those issues. So it imposes some kind of discipline in just thinking and acting. So anyway, enough of my observations. Any other questions?
There's a very good question, which I understand it's given in the chat box. With all the efforts of the financial inclusion, the Jan Dhan opening accounts, what would be the future of NBFCs? Are banks not capable now that the Jan Dhan accounts and everything has been opened?
For some time. Mr. Agarwal, do you want to take that? With all this electronic stuff and all?
I will. Sir, ever since this government has taken over, 100 million people have moved out of BPL line. The opportunity which India is posing today is unheard of. We are going to lead. This is India's century. We need to understand the growth rates are going to be mind-boggling. I can tell you from my experience, sir, up till 6 months, up till a year back, we were disbursing 300 loans a day on our internal system and everything. Today, we are easily clocking 3,000 disbursements a day. I'm talking of numbers, not in terms of value terms at all, which means more people are coming in system. We need not one State Bank of India, we need 10 State Bank of India. That's what government is trying to create. What we are missing is definitely good leaders, but I'm sure probably we will be able to find more people like Modi ji to lead us and lead us to a growth path. There is no doubt of business there. The growth and the need of this nation are enormous. Just a 25,000 rupees loan Just imagine, sir, the system, what people are out of, if I just reduce from 140 crore population, children and the females, well, I'm just saying the housewives, housemakers, not the housewives, and I say only 10 crore people are in system, that leave at least 20-25 crore people. 52 crore PAN cards have been issued in this country. Nobody is noticing that, sir. That's a data, government data. 6.5 crores of income tax payer, but 52 crore PAN cards. So we are heading towards a spurt which is 25,000 rupees loan to 20 crore people. We need 2-3 state banks to handle that volume.
Thank you. Okay.
I just want to add to that growth and all that. If you take the Bimaru states, you know that they have to meet the average per capita grow by the 700%, you know, that figure. To what extent that growth will be inclusive. So, I mean, I at least expect, you know, that very not sweeping remarks are more theoretically based and all that. India growth is a very lopsided.
Okay, so we'll conclude with Ms. Das and then Mr. Gopinath, your closing comments.
My closing comments remain, sir, which more or less what you have said, that we need a larger supervisory integrated portal stroke framework to take care of the rapidly increasing demand of the newly upwardly mobile Indian. Again, my limited point, there is a difference between theory and practice. We have to concentrate on the practice. We are bang on as far as the theory is concerned.
Thank you. Actually, that is something which Mr. Modi will also like. He likes, if there's theory, it must be implemented. Otherwise, it's no good. Okay, Dr. Gopinath.
Anyway, fortunately, thanks to people like our Sunil Agarwal, there are any number of platforms now that are offering loans. But yes, actually, NBFCs going forward will look to realign their portfolio strategies and focus on traditional non-asset classes. They would be, lending to micro, small, medium enterprises, affordable housing loans, used vehicle. All these are expected to grow rapidly. Consequently, these segments will corner a big chunk, and definitely there is a role for NBFCs in complementing and supplementing the banking system in reaching the 5 trillion economy or whatever. They do have a significant role, and let's not just worry about the number of the AUM asset. There is growth, but of course, with the merger of HDFC and HDFC Bank, you will have that one entity out of the NBFC numbers, so it will be seem to be lower growth, but it's not so just because of the exit of one. But yes, I'm sure the NBFCs, the symbiotic partnerships, all that will increase, and we would have.
Thank you. Dr. Charan Singh, you want to make some concluding remarks?
This has been a very interesting discussion.
Right. No, if you are going to make substantive, then I'll hand it to you.
No, I just want to make announcements now. I think we have had a very good discussion.
I'll just conclude and hand it to you. So basically, we haven't discussed it much, but the digital economy is going to drive India's growth in many, many areas. And of course, Mr. Agarwal mentioned fintech, but the ideas which are basically information processing, we are having new systems. You mentioned UID, Aadhaar, other ways we are generating information from all over the place. And really, the digital economy is the use of information. It's all about information. So, for example, the GST, the more people come on into it, the more information is generated, the more services, including financial services, will be supplied to these people who come into the system. So this digitalization has effects on the quality of education, on health, in finance, everywhere. So really, one of the key ways which is going to be, and that's what I would suggest to EGROW, because I'm no longer there, that Dr. Charan Singh, I think you could perhaps, especially if Mr. Agarwal is willing to finance some studies, I think you should take up. This is a very important issue. It's a futuristic issue. And not only will this help India, you can have a broader context in the G20 type of framework where some of these things have implication for other countries also. With that, let me thank all the participants and all the listeners. I see there are quite a few, and hand it over to you, Charan.
Thank you so much, sir, for chairing the session, which was amazing. The amount of information that has been shared, the innovative ideas that have been shared is really amazing. I must bring to the notice of the panelists as well as the listeners the Madam Dakshita Das point of theory versus practical. We have just come out with a working paper authored by Dr. Virmani, where we talk about the Bharatiya model of economic growth, which I think is pitching against the Western model of economic growth. You will find that there is a section on pragmatism, which means that you look at the empirical evidence and then you look at the practice and you bring it in practice. Similarly, Mr. Agarwal, I've heard you today very, very expressive about the growth path and the volumes that we are talking of. Of course, Dr. Virmani has used the word scalability, saying that the whole of Europe put together is half of India's population. But if you have a look at the Bharati model of economic growth, you will find that we are thinking in terms of that scalability already. And we also are thinking of sustainability, which is intergenerational, which means we are not looking at a time span of 100, 150 years or 250 years of growth. We are talking of a lifespan of 5,000 years of sustainable growth. Not only just intergenerational, but multi-intergenerational. That's the Bharatiya model that that you will find in the working paper on our website. Invite you to have a look at it. Yes, I must agree, sir. We have to be forward-looking, and we have to have a roadmap weighing, looking ahead in terms of the financialization and the financial sector component-wise in our country. Now, I'll take up the challenge and look how best to go about preparing, putting the team together, inviting some of you to help us in formulating that paper. With this, I must mention that today's intense discussion will be available on the website tomorrow. But after today's intense discussion, I've realized that there's a dichotomy. There's a global model of NBFCs, shadow banks. There's an Indian model of NBFCs, which has been highly, beautifully, systemically regulated much before the world woke up to it. So I'm going to be inviting the IMF team to come and present to us the chapter 2 of Global Financial Stability Report, which discusses this, as well as invite one or two international panelists. I'll also bring all of you in, I'll inform all of you, and maybe we should have one or two panelists from today to be part of that discussion. Next week, we have another interesting topic, but continuation of this. The failure of the banks in the US because of the aggressive rising in interest rate. So we are going to be speaking about the Signature Bank, the Silicon Valley Bank, and all that has happened in the last 2 months up there on these two. To discuss this will be Professor Arvind Subramaniam from University of California, Los Angeles, Anderson School of Business. He'll be presenting his research on this. I'd invite all of you to please join us. Time will be little late because of the time difference between Los Angeles and India. We'll start the webinar at 8 and close at 9:30. I'll invite all of you to be part of that discussion. Thank you once again to all the panelists, to the chairman for chairing the session, and all the participants to make it so rich and encouraging. Thank you.
Thank you,
Thank you, ma'am. Thank you, sir.